Have you ever wondered how Warren Buffett, known as the Oracle of Omaha, built a multi-billion-dollar fortune in the stock market? In this video, we'll take a chronological journey through Warren Buffett's investing strategy. We start with the young Buffett learning from Benjamin Graham and end with his advice on index funds and long-term investing. Along the way, we'll pick the brain of Buffett through his interviews and letters. So stick around. Get ready to dive into financial analysis, ask questions, and discover Buffett's timeless investing tips. By the end, you'll understand Buffett's approach to the stock market and maybe feel inspired to apply his advice yourself. Early Buffett and Graham influence. Let's rewind to the beginning. As a teenager, Buffett was already fascinated by numbers in business. He learned from Benjamin Graham at Columbia University, adopting Graham's value investing approach. He looked for stocks trading far below their intrinsic value, doing deep financial analysis on their books. Buffett recalled his very first stock purchase at age 11, and by his early 20s he was running an investment partnership focused on cigar-butt stocks, cheap companies with just a few good puffs of value left. During this time, Buffett was a strict value investor. Buy undervalued companies, hold them long enough, and let their true worth come to light. This was classic Graham: margin of safety, low price, big reward. Have you ever dug into a company's financials to find an overlooked bargain? Buffett did just that, analyzing company earnings and assets. But even Buffett would later tweak this rule, as you'll see next. Berkshire Hathaway and early bets. By the 1960s, Buffett was growing more confident. In 1965 he took control of Berkshire Hathaway, a struggling textile mill, planning simply to buy its stock cheaply. Instead, he kept the company and used it as a vehicle to invest in other businesses. At first, he still hunted for underpriced stocks. He made early big bets on companies like American Express during a crisis, the Washington Post, and others that looked undervalued. These were still Graham-style purchases, buying solid companies at low prices and waiting for the market to notice. And like any patient investor, he often held through tough markets. Do you think you could hold on to a stock when everyone else is panicking? Buffett did. He famously said that for most investors, don't look at the stock ticker tape every day. Just keep buying. American business is going to do fine over time. His point? Focus on the business's value, not short-term market noise. Charlie Munger's influence: quality over cheap. A turning point came in 1978 when Charlie Munger joined Buffett. Munger convinced Buffett to shift from purely cheap bargains to also seeking great companies. Munger's mantra was, buy wonderful businesses at fair prices, not fair businesses at wonderful prices. In other words, quality matters. Munger also taught Buffett about compounders, companies that reinvest profits at very high rates. Suddenly, Buffett began focusing on strong brands and businesses with huge moats. For example, Buffett picked up See's Candies in 1972 and Coca-Cola in 1988. He saw enduring brands and customer loyalty, and he was willing to pay a fair price for those qualities. He adapted Graham's lessons by blending them with Munger's wisdom. Picture the difference: instead of small, deeply discounted companies, Buffett bought fewer but bigger stakes in great companies. He once phrased it like this: we aim to find great businesses at good prices, rather than just good businesses at great prices. That's Buffett's matured philosophy: long-term bets on quality. Long-term focus and stock market philosophy. Through the 1980s and 90s, Buffett's approach was clear: think long-term, pick businesses you understand, and ignore short-term market fads. He treats each stock as part ownership of a business, not as a ticker symbol. One of his favorite quotes sums this up: in the short run, the market is a voting machine; in the long run, it is a weighing machine. This means the stock market may swing wildly, voting up and down, day to day, but eventually it weighs the true value of good companies. He looked for a few key traits: simple business models, consistent earnings, honest management, and lots of cash flow. Using Berkshire as a holding company, Buffett bought whole companies, like Geico, BNSF Railroad, Dairy Queen, and large stock positions in others. These businesses were often monopolies or near monopolies in their markets. He ignored tech stocks for decades, saying he only invests in businesses he understands. In fact, he famously passed on investing in Google and Amazon early on because he didn't grasp internet businesses. By now, Buffett's wealth was soaring. But he kept doing his homework, and he kept a down-to-earth style. In interviews, he often reminds people, be greedy when others are fearful, and fearful when others are greedy. He doesn't just give abstract wisdom, he shows it by example. Modern era, index funds and Apple. What about recent years? Interestingly, Buffett has become a big advocate of index funds for most people. In 2013 he wrote that the most sensible thing, for investors, is to buy a very low-cost S&P 500 index fund. In fact, his famous 90-10 advice to family trustees was, 90% in a low-cost S&P 500 index fund, 10% in short-term treasuries. Why? Because in aggregate, the U.S. economy grows over time, and a passive index fund captures that growth with minimal fees. Buffett beat a bundle of hedge funds by betting on an S&P index fund over 10 years, proving passive can win over active management. At the same time, Buffett adapted to pick huge tech-related opportunities when they fit his criteria. In late 2016 he started buying Apple. After decades of avoiding tech, he saw Apple not just as a gadget maker, but as a consumer products giant with incredible brand loyalty and pricing power. Berkshire invested about $40 billion into Apple, and it became his largest position by value. Even though he sold some Apple stock later, partly due to tax reasons, the bet paid off enormously. Through Apple, Buffett showed he could update his strategy, focusing on companies with the courage to build large positions, patience to hold through volatility. Passive investing wisdom and mirror strategy. By now, one clear lesson is that Buffett Warren's strategy blends active and passive ideas. While Berkshire buys specific stocks, Buffett's investing advice for you is often quite simple: stick to index funds. If you want to mirror Warren Buffett's investment strategy, consider this: for most investors, a broad index fund is the easiest Buffett-approved approach. It mirrors the aggregate market that Buffett has thrived in. And in Buffett's own words, this is masterful humility. He doesn't claim to predict stocks, he trusts the long-term success of American business. As he said, owning stocks is like owning a piece of the American economy. And our economy is going to outperform. So whether you pick quality individual stocks, like Buffett, or buy an index fund, as Buffett advises most people to, the heart of the strategy is the same: focus on business's fundamentals and play the long game. Your turn, engagement and takeaways. Now it's your turn. Which lesson from Warren Buffett resonates with you the most? Do you lean toward buying great brands, or would you feel comfortable simply holding an S&P 500 index fund as he suggests? Let us know in the comments. And if you found these insights helpful, give us a thumbs up. Remember, Buffett's strategy wasn't built overnight, it was a journey of learning from Graham and Munger, staying patient, and always thinking for the long term. So here's a final question for you: if you could invest like Warren Buffett, what would be the first stock or fund you'd buy? Comment below with your picks. Thanks for watching, and don't forget to subscribe for more investing wisdom. Until next time, keep learning and keep investing wisely.